I am the Chief Investment Officer and one of the founding principals of Multnomah Group. I appreciate everybody taking the time to join us today for this presentation on evaluating and monitoring target date funds. We're going to talk a little bit today about qualified default investment alternatives in the context of how they were created and how they impact 401k and defined contribution plans, and provide a little bit of context on the target date fund universe, and then get into some of the guidance the Department of Labor has given plan sponsors with respect to target date funds. And then we're going to focus on, as plan fiduciaries, how you should go about selecting and evaluating target date funds, and certainly wrap up with any questions that you may have. Before we get started, a couple of housekeeping items. For audio quality, we have all the attendees on mute. If you have any questions, feel free to use the Q&A and chat panels in Zoom to submit those, and we'll try and get to those as we go, or at the end, certainly. We are recording this presentation, and we'll be sharing both the slides as well as the recording with everybody that registered for the presentation. So you'll get a follow-up email from us with that in the next few days. So when we talk QDIA, or Qualified Default Investment Alternatives, this is a concept that originated with the Pension Protection Act in 2006, so it's been around for about 14 years. At the time, the Department of Labor's objective was to ensure that investments that were chosen as the default within a retirement plan, a defined contribution retirement plan, were appropriate as a single option for workers' long-term retirement savings needs. Prior to the Pension Protection Act and the advent of qualified default investment alternatives, most plan sponsors picked a default investment option that was a stable principal investment vehicle, a money market or stable value or fixed annuity product, something that didn't fluctuate in price on a daily basis. And that's because I think most had defined risk as short-term market volatility, which and they were choosing default investments that they thought were the least risky for their participants. I think the problem was that a lot of research was showing that participants that were defaulted into investments stayed in their default. And while a money market fund may be least risky in the short term from a market volatility perspective, it creates a great deal of risk for retirement outcomes for participants. If you're invested in a money market fund that is paying 1 or 2%, you're probably not going to accumulate sufficient assets over your lifetime to have a safe and stable retirement. So the Department of Labor's goal was to create some safe harbors that allowed people to better choose investments that were focused on long-term retirement savings needs for workers. The final regulations that the Department of Labor issued basically created 4 categories of products that qualified as a QDIA. The first is a product with a mix of investments that take into account the individual's age or retirement date. Those are target date funds, and they're going to be the focus of our presentation today. The second was an investment service that allocates contributions among the existing investment plan options, that provides an asset mix that takes into account an individual's age or retirement date. These you'll frequently see referred to as managed accounts. Becoming more popular in retirement plans as cost comes down and technology improves, but managed accounts are eligible to be chosen as a QDIA. And then the third is a product with a mix of investments that take into account the characteristics of the whole group of employees. So typically these are balanced funds or risk-based models, a single model that a plan sponsor thinks kind of works for the whole of their population. And then the last is they included a provision that says you can choose a capital preservation product like a stable value or money market fund, but you can only do that for 120 days. And after the 120 days, if the participant hasn't done anything else, they need to be re-defaulted into one of the other categories. The Pension Protection Act created a safe harbor for plan sponsors that basically said if you chose one of these 4 types of investments and still chose them prudently and followed some disclosure requirements with participants, that you were protected from a participant who may complain that you put them in an investment option that lost money and defaulted them into that. So it created this safe harbor guideline. It's important, though, to understand what that safe harbor is. It doesn't eliminate any requirement that plan sponsors still go through a prudent process for selecting the QDIA. It's just saying that if you have chosen these types of products and they are, you had a prudent process for that, you do receive some protections from participants. As we look at the market since the Pension Protection Act, far and away, target date funds have become the dominant QDIA investment option for plans in the United States. And that's seen coinciding with that a kind of a huge explosion in the usage of target date funds in plans. These products were first launched back in 1994, and at the end of 2003, so prior to the Pension Protection Act, there were 16 target date fund series on the marketplace. As of the most recent Morningstar Target Date Fund Landscape Report, there are now 63 target date mutual fund series available in the market from 40 different investment management firms. And if you expand the universe to include collective investment trusts and some insurance products and separate account products, the number of target date fund series grows even more significantly. While we've seen a huge expansion in the number of target date fund series that are available and their usage more broadly, what we see is that it continues to be a pretty narrow market in terms of the dominant providers. Of the over $1 trillion that are invested in target date funds, the top 4 providers being Vanguard with over a third of the market, Fidelity, T. Rowe Price, and American Funds. Those 4 providers represent over 75% of the total assets in target date mutual funds. So we see a pretty significant, a breadth to the number of investment series that are out there, but it's a market that's pretty heavily dominated by the top few providers. If we look at the timeline of kind of target date fund adoption, we had the Pension Protection Act in 2006 and the DOL guidelines that followed that. And what we saw is, the shift that had started before the Pension Protection Act offering these in the investment menu picked up pace as participants as plan sponsors started to use them as the QDIA. Seeing the growth in assets in this space, in 2013, the Department of Labor issued some guidance, and there's a link here to the fact sheet that the Department of Labor put out. And this was guidance for plan sponsors about their role, or as plan fiduciaries, their role and responsibility in selecting a target date fund. And what the Department of Labor said was plan fiduciaries should establish a process for comparing and selecting target date funds. I think this was important because up through the Pension Protection Act and even in the years that followed that, one of the most common things that we saw was that plan sponsors were choosing the proprietary target date fund of whoever the record keeper was. So if you were a Vanguard client, you chose the Vanguard funds. If you were a Fidelity client, you chose the Fidelity funds. And there wasn't really a process that most plan sponsors had for comparing and selecting funds. The second bullet that they said is you should establish a process for the periodic review of those funds. So you should have prudent processes for picking them and prudent processes for reviewing them. What that prudent process is kind of gets into the next bullets. They said you should understand the fund's investments, the allocation that they have to the different major asset classes, whether it be stocks, bonds, cash, the individual investments that they have, and how these will change over time, the glide path that we'll talk about in a little bit. Part of that process, it should also include reviewing the fund's fees and investment expenses. And you should inquire about whether a custom or non-proprietary target date fund would be a better fit for your plan. And I think probably the greatest emphasis was on non-proprietary target date funds because, again, we had seen such heavy adoption of proprietary options. The Department of Labor also said we should develop effective employee communications to communicate to employees about these funds. And then we should take advantage of the available resources of information to evaluate and recommend these products for our plan. So looking at things like prospectuses and investment manager reports and record keeping data. And then lastly, as all things prudent fiduciary, we should document that process. So we should have in place prudent process that's well documented that shows that we understood what we were buying and we made a good comparative evaluation. The problem, though, that we run into is that the processes that most plan fiduciaries have had with respect to selecting and monitoring the investment options don't really work that well for target date funds. And the reason for that is they're not all the same. There's a lot of differences there in things that can have a pretty significant material impact on performance for those funds and for the investors in them. We see differences with respect to the investment objectives that the target date fund managers may set. Some focus on maximizing the retirement savings, accumulation of assets. Others focus on providing a minimum replacement level of income for the broadest number of participants. So they have different investment objectives, and that leads to different glide paths. So the glide path is the mix of stocks and bonds and how that changes over time. Some are managed to retirement, so that the idea is they get to their most conservative allocation at the target retirement date. Others think it's prudent to manage through retirement, so they continue to decline in equity allocation past the target date, as long as up to 95 years of age. We see differences in the equity allocation at retirement and the terminal equity allocation whenever it gets to its most conservative point. We also see differences with asset allocation, the mix of asset classes that are used within the glide path, some traditional asset classes, some non-traditional asset classes, and how they manage inflation risk assets. And then differences in investment management, active versus passive, proprietary versus open architecture. All that's to say is there's a lot of moving parts to these funds that makes the traditional evaluation of a manager, if we picked a large growth manager and we looked at the performance of that fund versus its benchmark and its peers, understood their investment process, that's pretty simple and straightforward. Target date funds, there's a lot more moving parts and differences that can impact performance that we need to understand. So as we look at what a prudent process is for selecting a target date fund, we really think it comes down to a couple steps. The first step is to evaluate your plan preferences, and we'll talk a little bit more about this in just a second. Once we have an understanding of what the plan preferences are, we need to do the investment due diligence. And based on the plan preferences and the due diligence, we then want to select the target date fund series for our plan. So when I say evaluate plan preferences, I really kind of bucket this into three broad levels of preferences that we see. The first is plan demographics. So here it's important as plan fiduciaries that I think we understand the financial literacy of our employee population, their average age, average income, average deferral rates, how likely are they to use a target date fund as the sole investment, or are they mixing it with other investments within the plan? How likely are they to retire at age 65? And are the assets going to stay in the plan post-retirement? And how knowledgeable are they about converting lifetime income at retirement into, or the accumulated balance into lifetime income at retirement? So an understanding of our plan participants and their behaviors and knowledge about investing, I think, is really important. And we'll talk about why and how that may impact the decisions you make about target date funds in just a couple minutes. The second kind of set of plan preferences is plan design. Whether you have auto enrollment, auto escalation, the availability of defined benefit plan for your population, or the availability of lifetime income tools. Those plan design features will have an impact on the appropriateness of the target date fund that you may select. And then the last set of plan preferences really comes down to committee philosophy. How does the committee define their objectives for the plan? What is their comfort level and knowledge of traditional versus non-traditional asset classes? How do they view market risk versus longevity risk? Are their goals to minimize the downside for participants or maximize upside? How do they view inflation risk, active versus passive management, proprietary versus open architecture? These are really committee decisions, committee philosophical decisions that should be discussed before selecting a target date fund series. So as we look then at kind of how that turns into some of the decisions that we see, I mentioned there's a number of moving parts. The first that we look at is glide path structure. And glide path is kind of that mix of stocks and bonds, as we talked about, and how that changes as we approach the target retirement date. Do we think there's appropriate levels of growth or equity at different points in the glide path? The next thing that we look at is the landing point, the to versus through question that we see discussed frequently. At what point do we think we should reach the terminal equity allocation, so the lowest equity allocation within the target date series? And if we go through, how long should we go past the target retirement date and continue to decline equity allocations? Similarly, non-traditional asset classes, it's a philosophical decision for the committee to what extent do we want managers to allocate to non-traditional asset classes, either to diversify risk or to potentially enhance returns. And along those lines, not just an asset class decision, but the decision around active versus passive. So all of these funds, and we'll talk kind of how the structure of them, ultimately come down to some investment decisions about how they're going to implement the glide path and the asset allocation. And do we have a preference for managers that are using active funds seeking to outperform indexes in the market, or are we more comfortable with a passive target date fund series? And then lastly, looking at proprietary versus open architecture in the investment management. And we'll talk a little bit about that in just a minute. So we highlighted, all of those different things going back to the plan preferences, the demographics, the plan design, the committee philosophy. And it's really important to understand that all of those things in some way impact some of those evaluation criteria that we just talked about. Some of them go to what an appropriate glide path might be. Some of them may go to what an appropriate landing point is, or how comfortable we should be with non-traditional assets, active versus passive, or open versus proprietary. If we were to weight this out, what we see is that most of those plan preferences really come down to, making a good and prudent decision about the suitability of the glide path for our plan population and for our investment philosophy. To a secondary degree, we're looking at the landing point and what's an appropriate landing point. And then we get into, maybe lesser decisions, but still important ones around the use of non-traditional asset classes, active versus passive, and open versus proprietary. So as we go back, that first step is understanding our plan preferences so that can inform the decisions that we can make about the appropriateness of the glide path, the landing point, and the use of asset classes within the glide path. So that's step one in the process. The second step is to do the investment due diligence. And we think prudent investment due diligence really looks at all of these things, starting with an understanding of the investment management firm. Then proceeding to understand glide path construction, the asset class selection, portfolio implementation, tactical allocation, and operations. And we'll talk about each one of these steps and what we think is the questions we should be asking and the information we should have as part of our due diligence process. Starting with the firm, it's important to understand, the importance of evaluating and doing the due diligence on the investment management firm. And part of that is the fact that with the adoption of target date funds or any asset allocation fund, we're really taking a set of responsibilities that historically lay with the participants and shifting that to the fund manager. So in a traditional defined contribution menu where participants are given a bunch of building blocks and they can build their own portfolio, the asset allocation and rebalancing and decisions and the level of risk, all of those decisions are left with the participant. Here, we're basically taking and saying those no longer are the responsibility of the participant, but they're the responsibility of the target date fund manager. And so we're asking them to do asset allocation work in addition to security selection work. And so as we transition that responsibility, we think it's really important to understand how stable the firm is, their experience with that type of work, their commitment to these funds, the people, processes, and resources that they have committed here. So why do we care about stability of the organization? I think it's because these target date funds are designed to last a participant's lifetime, 40 to 70 plus years. If you start at age 22 in the workforce and you work till age 65, you could be invested in a target date fund series for 40 plus years. And for those that are designed through retirement, you could be there your whole lifetime, 70 plus years. What we do know is that over a 40 to 70 year lifespan, these funds are going to need to grow and adapt. There's going to be new asset classes that become available in the market. We're going to see changing market dynamics and new investment research that talks about appropriate ways to manage portfolios. it's really important that you have a stable organization that we think can last long term to manage these portfolios. I would also couple that with the fact that while it's unlikely that we're in any single target date fund series for 40 or 70 years, I think there's a desire both from participants as well as from plan sponsors for low turnover of the target date fund series. As we look at plan assets, these are becoming far and away the largest allocation within plans. And so if you, or as a plan fiduciary, are deciding to make changes to the target date fund series, it's a pretty significant communication hurdle that you have to clear to communicate this to your participants. And if we see frequent turnover of these products, I do think it tends to erode the confidence that plan participants may have in the plan fiduciaries selecting the investments for their plans. So I think everybody is really focused on trying to find target date fund series that can last for the long term within their plan investment menu. Understanding the stability of the organization, then we, I think, have to look to the experience that the firm has in creating asset allocation portfolios. Most of the investment management firms that are successful, that we're familiar with, are primarily successful because they are good single asset class investment managers. Their skill historically has been in selecting individual securities. So if you think back to the traditional, the Peter Lynch, Fidelity Magellan, and look at other firms like American Funds or T. Rowe Price or others, they've made their name primarily by, within a single asset class, doing a very good job of managing their stock or bond portfolio and adding value. Asset allocation work is investment work, but it's different investment work. And so, it doesn't necessarily follow that a good stock picker has the skill and experience to create appropriate asset allocation portfolios. So as we look at understanding experience, I think we're trying to figure out, do they have the experience and the knowledge that goes beyond just the security selection decisions to manage these portfolios and do it well. And there's things that we can look at, I think, other types of experience that's relevant, whether it be outsourced pension investing, building pension portfolios, doing investment consulting work, managing other target risk portfolios, or some track record managing target date funds. These products have now been around for 14 years since the passage of the Pension Protection Act. So we do see, for many of the largest providers, a pretty long track record of performance. But as you look at newer providers or people that are coming to the market, I think it's important to look and see if they have any other experience that's relevant to this work. Another thing we want to evaluate with the fund manager is their commitment to target date fund investing. And that shows up in a few different ways. Do they have dedicated staff for managing these portfolios? As the assets have grown and we're now at over $1 trillion in target date funds, these products, for the simplicity that they have for participants as a set it and forget it investment option, do have a fair amount of complexity under the hood. And I think it is important to have dedicated portfolio managers and researchers that focus solely on these products. Other measures of commitment are the target date funds a core product for the fund manager? You can look at things like the percentage of assets, where they're positioned within the org chart, how they spend marketing dollars to try and promote them. You want them to not just be an add-on that they put together because they saw everybody's doing target date funds. We need to have a solution, but you want it to be core to what they're doing so that the resources are there to invest in these products. Do they have sufficient traction in the market to support long-term viability? I mentioned the top 4 providers are north of 75% of total assets. We have a very long tail of target date funds, to get to the 60+ target date fund series. We have seen over the past decade or two, some managers launch products, never get the traction they want, and then close them. That creates a lot of disruption. If you were a plan sponsor that chose one of those products within your plan, you have to go out and choose another option, communicate that. So you do want some level of assets in the products to make sure that they're going to be around and an important product for the investment investment manager. And the last way that we can measure commitment is, are they providing any thought leadership within the target date fund universe? Are they putting together research papers, publishing white papers, or other ebooks or FAQs or presentations that show that they're really thinking critically about the needs of target date fund investors and the best way to manage them? At the firm level, we want to look also at the people and understand the experience that the portfolio managers have with asset allocation funds. How long have they been doing this? And to what extent do they have other responsibilities within the firm? Some of that also gets back to the commitment discussion. If this is a side job for a portfolio manager that also manages a large cap growth portfolio, it's probably a clear indication that these funds aren't a priority and may not get the commitment and resources from the investment manager to continue to manage them. And then we want to understand the process that they have for managing them. How do they evaluate changes? Have they managed these products before? Do they have processes for managing cash flows, rebalancing the products? As I mentioned, there's a lot of simplicity to participants, but that's coupled with complexity under the hood in terms of how do they make changes to Glidepath, asset allocation, investment management products. How do they handle cash flows and rebalancing within the funds? We want to understand if they have prudent processes to handle that complexity. Once we understand the firm, next step is to evaluate the equity glide path. This is just kind of a very simple visual representation of what the glide path is. So on the far left, if we look, we're looking at the split between stocks and bonds in the portfolio. And the younger we are, we start with a more equity-oriented glide path. In this case, 90% stocks. And that probably will hold static for some period of time, but as you then start to approach the retirement date, what you see is the allocation to stocks will steadily decline over time, and the allocation to bonds will offset that as you age, so that the portfolio naturally gets more conservative as you approach that retirement date. Broadly speaking, we see two types of glide paths. There's two retirement glide paths and there's through retirement glide paths. The two retirement glide paths are those that get to the most conservative equity allocation at the retirement date. So they're designed to get you to retirement. And as we look at investment managers with two retirement glide paths, what we find is there's really two investment theses that have led to the decision to manage to retirement. The first is a human capital thesis. And the idea is that as investors, we should maintain a static risk exposure throughout our time horizon. And if you look at an investor's assets, they have financial assets, which are savings and retirement, but they also have their human capital, which is their future earnings and Social Security. Those future earnings and Social Security benefits are very bond-like. They're stable. They don't change much year to year for most participants. And so they provide the bond-like asset allocation within the whole of a participant's capital profile. As you age, your future earnings, the current value of your future earnings and Social Security decline. And so as that bond-like allocation declines, you need to increase your bonds and your financial assets. So that's the rationale for why the bonds increase, is they're increasing to offset the decline in human capital that people have as they work and age. At retirement, the present value of your future earnings and Social Security is basically fixed. Social Security may fluctuate a little bit, but the future earnings are basically zero. So at that point in time, your financial assets should have their highest bond allocation, and from that point forward should be pretty static. So that's the human capital thesis. The second thesis that we see is an observed behavior thesis. And the idea here is that it's really hard to understand what participants are going to do with the money at retirement or past retirement. And they look at record-keeping data and have found that participants don't act rationally. So most target date fund providers have a model that they create when they build their fund. And it says, we're going to design this product for somebody that starts in the workforce at age 22, starts saving 6% of pay, increases that to 10% over their work life, and gets 3% salary increases every year. And if they follow that pattern and take the money out at retirement, they should be fine. I think what the actual data shows, if you look at record keeping data, is that participants don't behave that way. And there's a lot of uncertainty as to what they do at the endpoint. We see large distributions near retirement, and it's hard to understand what happens at that point. So the idea with this is that our goal then should just be to get participants to the endpoint rather than trying to build a product that tries to get them all the way through their lifetime. And at the endpoint, they can make a decision as to what they want to do. Two retirement products tend to impact the glide path in a couple ways. First, as I mentioned, they reach their most conservative allocation at the retirement date. What we also find is that they generally also have more conservative allocations in the near retirement years. So as you are leading up to that target retirement date, they tend to have more conservative equity allocations compared to through retirement. That's because they're trying to get to that endpoint sooner. We also find that these funds then merge away. So at the retirement date, so we're in 2020, most of these products are offered in 5-year increments. What we'll see is that the two retirement investors that are in a 2020 fund are likely to be merged into a retirement income fund this year, because at that point, 2020 and the retirement income fund basically have the same allocation, and it's a static asset allocation going forward. The other glide path structure that we see is through retirement. And there's two different investment theses that we see with why a through retirement may make sense. The first is kind of, I think it's maybe polite to call it a mean reversion of assets. It's really probably not much of an investment thesis, but the idea is we think equities outperform over the long term. Investors have a long time horizon, so they should have equities through into retirement. Not necessarily a lot of intellectual capital that goes into supporting that, but just kind of looking and saying, yeah, we're going to build this glide path that kind of goes through retirement. We think that makes sense. The second and probably more common reason that we see a through retirement glide path be discussed is that there's a belief that equities are necessary to counter longevity risk. And for most investors, longevity risk is going to be a greater risk to them than market risk. So market risk being volatility. And the belief is with two retirement or more conservative glide paths, when we're trying to balance market risk versus longevity risk, we're too focused on market risk because that's what we see and feel in the short term. And so the idea with through retirement is that we're really focused on managing for that longevity and inflation risk that is there over a person's whole lifetime. And in order to do that, we think we need higher equity exposure to provide sufficient income in retirement. The to versus through discussion or debate is pretty common and can get very heated between the different providers that think their way is the right way. I do think, though, from a contextual perspective, if you go back and look, where the money is almost exclusively in through retirement strategy. The top 4 providers that I mentioned are all through retirement. I think JP Morgan's probably the largest, and they're number 5 that is a to retirement provider. So the debate, while important to understand, I think the investment objectives of your investment provider, the debate of to versus through is maybe too simplistic of an evaluation of target date funds. Through retirement glide paths tend to decline in equity allocation to some date post the retirement year, which is generally targeted at age 65. Could be 5 years up to 30 years past retirement. The ultimate terminal date can vary across different managers. In contrast to retirement glide paths, they tend to have generally higher equity allocations approaching retirement and at the retirement date because they're going to continue to decline over time. And participants are likely to maintain their age-specific fund past the retirement date. So you'll see still funds like a a 2010 or a 2005 fund that exists and may question, well, why is that? We're well past that target date. And it's because those are through retirement funds that would continue to decline in equity allocation over time. If we look at the universe of target date funds, what we see is a pretty wide spectrum of glide paths. For those farthest from retirement, we have glide paths that range from 80% to 100% equity. And probably the greater variance is as you start to approach that target date. You can see a variance from 25% up to 78% of equity as you get towards the target retirement year. So glide path can have a pretty significant impact on the performance of a fund, whether they're more conservative or more aggressive. And to better illustrate that, we can look back at the financial crisis of 2008, 2009 to understand the impact of glide path. And here we have two target date fund series. And if we focus just on the blue bars in 2008 and look at the first two series, we have a 2010, what we would call an aggressive glide path target date fund series, and a 2010 conservative glide path series. In 2008, the aggressive glide path was down almost 27% versus the conservative glide path that was down almost 11, almost a 15% gap in performance for somebody that was nearing the retirement date. Conversely, in the recovery period of 2009, the opposite was true. The 2010 fund recovered, was up almost 28%. The conservative glide path was up about 13%. Looking at the 2050 funds, so those funds at the far end of the glide path spectrum, you see some differences, but less. And I think that ties back to that chart that we showed where the variance for funds that are farthest from retirement is narrower. The greatest variance comes as people approach that retirement date, and it shows up in the performance of funds in extreme market environments. Once we understand the glide path, we have to figure out the asset allocation within the glide path. So glide path is really just talking about the mix of stocks and bonds broadly, or stocks and fixed income. Within those buckets, those two buckets, then the investment manager needs to select the asset classes that they're going to include. And as we're doing our due diligence to evaluate these products, we want to understand which asset classes are they including in the overall portfolio, and do we think they provide sufficient exposure to broad global capital markets to diversify our investors. Generally, I think that is the case. You'll see differences in what target date fund managers provide in terms of the asset classes that are in the portfolio. I think it's important to understand how they went about the process of determining what would be suitable. Did they do modeling of historical returns or future expected returns? What were their capital market assumptions? Are they using historical or forecasted data? What was the research that went into how they built these products and chose which asset classes to include? We also want to understand what impact the fund managers' other investment products play in determining asset classes. Did they include or exclude specific assets because they had or didn't have a product there? I've seen managers that didn't have emerging market stocks in their portfolio. And when we talked about it with them, it was because they didn't have an emerging market stock fund. They ended up launching an emerging market stock fund. The first investor was the target date fund series. So, it was not ideal that before that they thought that it made sense to own emerging market stocks, but didn't have a mechanism to do that, so left that out of the target date fund series. I've also seen managers that included asset classes that most other managers don't have because they have a unique product there. It could be preferred stocks, it could be direct real estate, it could be a stable value, it could be something that is unique, but as you dig in, they seem to have included that because they have a product there that they want to get some distribution. So, understanding how they made the decision to include what they did is important to understand, whether we think these products are right or appropriate. And then we need to understand how do they review and update that. As I mentioned, if you go back, these products are designed to last for the long term. We expect over time that the asset class asset classes within the portfolios will evolve. They should add some, they may take some out. We want to understand the process that they have for reviewing that, and what recent and potential future changes are they making to the asset classes that are included in the portfolio. As we look at asset classes, I tend to bucket them into kind of three broad categories that we see within target date funds. And the first bucket is the standard asset classes. These are what everybody has. They have cash, they have intermediate bonds, they have US equities, both large and small mid caps, they have international equities. It's kind of the base case for what most have. Then we see two other categories that some target date fund managers include. And the first, I would say, are the portfolio diversifiers. These are asset classes that investment managers are including in their target date fund series, primarily because they think they either enhance the return of the target date fund series or they may reduce the risk. This could be things like stable value, high yield or global bonds, preferred stocks, small cap international stocks, emerging markets, or some put in volatility or risk parity portfolios. Those are niche asset classes that we think are included primarily to diversify the portfolio and enhance returns, reduce risk. The third category we see are the real return hedges. So some target date fund managers take a very inflation-focused view of the investment objective. And one of the primary concerns or risks that they may have or think participants face is the risk that inflation erodes their purchasing power. And so they include real return-focused asset classes like TIPS, commodities, real estate, either REITs or direct-owned real estate, or natural resource stocks, really with a focus on providing some real return or inflation hedge within the portfolio. Not all target date fund managers have all of these. Most have the standard asset classes and then are picking and choosing from some of the category 2 or category 3 components, but it's important to understand what they're doing and what choices they've made there. And again, to kind of demonstrate the impact of this, I think it helps to look at the last financial crisis to see some of the market extremes and how this impacted target date funds. So if we look at 2008 returns at a high level, what you can see here is for different indexes, the performance that we had. Most bonds did all right, credit did not great, stocks did pretty poorly. High yield, though, performed very stock-like in the financial crisis. It was down 26%. Again, if we look at two target date fund series, and these are real fund series, one a 2010 fund and one a 2015 fund. The 2010 fund had 42% in US stocks. The 2015 fund had almost 50% in US stocks. Thinking just from a Glidepath perspective, we would think the fund that had more in US stocks would have more risk in the portfolio. But if we looked beyond just the Glidepath evaluation to understand the asset class level allocations, what we see is the 2010 fund, while it had more in bonds, had a pretty significant portion of the portfolio in high yield bonds, almost 16%. As a result of that, the 2010 fund that from a Glidepath perspective you might have thought was more conservative was down 30% in 2008. The 2015 fund that would maybe seem more aggressive from a Glidepath perspective, because the asset class allocations were a little bit more conservative on the fixed income side, was only down 24%. So asset class allocation can have a pretty significant impact on performance. And this was looking at 2008 data because it was kind of the most recent test case where some of these variances show up. But as we look at the current market environment, I think you're likely to see similar stories where certain target date fund managers that were more allocated to niche or credit asset classes may underperform managers that were more defensive with their fixed income or asset class decisions. And that is a separate evaluation from the Glidepath discussion, the stock bond split. As we progress through kind of the evaluation for selecting funds, we need to understand the firm, the Glidepath, the asset classes that they are including. And then the next step for a target date fund manager is to implement that portfolio. And generally we see three approaches. You have those that implement using active portfolio management. Active management seeks to outperform a benchmark and they're looking to add additional value through the manager's skill in timing the market or selecting securities. Active management tends to come at a higher cost, but with the potential for outperformance, although that outperformance could be both positive or you could see negative performance relative to benchmarks if the skill isn't there. Conversely, you'll see some managers use passive portfolio management or index-based management. Index funds or passive portfolio management seeks to provide market rates of return by using portfolios that are designed to track the benchmark by replicating or sampling that index. They tend to be lower cost, but you're giving up the opportunity for outperformance. Most target date fund managers are either fully in the passive camp or in the active camp. Although you will find some target date fund managers that are using a hybrid approach where they combine active and passive strategies into a single portfolio. And they may choose to go active in certain asset classes where they think they can add value and index asset classes that they think are more efficient or maybe not in their skill set. Hybrid strategies can be used to reduce the cost of target date funds compared to a fully active strategy, but that's not always true, and sometimes the cost savings aren't significant compared to active. If you're using an active date or an active target date fund series, you need to understand and use the usual criteria that you use for evaluating active core managers. Understand their people, process, investment philosophy, cost capacity. Active management adds a layer of risk to target dates in that you could have manager skill be positive or negative. And if you see a target date fund manager using active management, you then need to understand what their process is for selecting the active managers. How do they evaluate them? What happens if they underperform? Do they have a process for removing or replacing those managers? If you're using a passive target date fund strategy, you need to understand kind of the usual index manager evaluation criteria, understanding costs, experience, tracking error, and does the index provider have access to a broad enough set of index strategies to provide the exposure that we want? If we go back to the 3 buckets of asset classes, it's very easy to index category 1, cash, bonds, large cap, small cap US stocks, international equities. It gets more difficult to index the portfolio enhancers and the real return hedges. So do they have enough capacity and product to build the type of portfolio that you want is the question to ask. And then we need to look at not just active versus passive in the investment management decision, but proprietary versus open architecture. So proprietary investment management really means that all the underlying portfolios that are used to populate the target date fund are managed by the same investment manager as the target date fund manager. Far and away, this is the most prevalent form of investment management in target date funds. So it's very common, and most likely if you have target date funds, that this is what you have. But it does create a few challenges to consider. I think the first is, perceived conflicts that could exist between the target date investors and the fund manager. And that can show up in a couple different ways. You could have a target date fund manager that chooses to select funds that maybe otherwise aren't getting the distribution that they want. And so they see a pool of assets that they could allocate there and put money in that. You may also see a situation where the target date fund manager would like to potentially terminate one of their proprietary investment options, but know that that would have a negative impact on that fund, which within the same organization. So may be more reluctant to make changes with underlying investment management. So there can be conflicts there that need to be evaluated. And it also can expose investors to potentially highly correlated alphas. So if you have an investment management firm that has a very singular and distinct investment style, while they may have multiple funds, if the style is such that the alpha are highly correlated from all those products, you're not getting the diversification of manager skill that you hope to have. And if the strategy's in favor, all of the funds, underlying funds would do well, but if not, all of them may struggle at the same time. You may also choose to use open architecture. In this case, the target date fund manager uses outside portfolio managers in each of the asset classes and buckets that they've created. This is less common in mutual funds. It's maybe a little bit more common in collective investment trusts and certainly separate accounts. It can add a layer of fees though, because the target date fund manager in a proprietary vehicle, generally would have low to zero fees at the target date level and make money from the underlying investment strategies that they use. In an open architecture structure, the target date fund manager needs to get paid and the underlying sub-advisors need to get paid. So it can add some additional fees to these products. And it's important to understand, well, I think generally we like open architecture. It's not necessarily a guarantee that you're going to get higher performance. We've seen some cases where open architecture vehicles don't outperform because it's still very difficult to pick active managers that can outperform over the long term. So this is less common, but certainly something that we do see from time to time. And then lastly, similar to the active passive hybrid, we see some hybrid strategies where they use a combination of proprietary investment vehicles and then sub-advised vehicles in cases where they maybe don't have the internal capability to manage certain asset classes. Again, this creates some of the same conflicts that you have with proprietary investment management when you're trying to understand the decision making. What should we use, proprietary versus open architecture? So if we go back to kind of the beginning, the process, we start with the preferences and understand the plan preferences and how that can inform the decisions we make. Then we need to do the due diligence, looking at the firm, the glide path, asset class selection, investment management. And putting those two things together, we then select the target date fund series that we think is right for our plan and for our plan population. Once we've done that, we need to monitor. If you go back to the DOL guidance, we need to have a prudent process to select these and compare these funds. And then we need to have a prudent process to monitor these target date funds. And I think the prudent process for monitoring really is focused on those same things that we did with the selection. And understanding, has anything changed from our initial analysis? And that could be periodically, every few years, reviewing the plan preferences. So if our demographics change, if our plan design changes, if our committee's philosophy changes, has anything changed with our plan preferences that may impact our decision? And with our due diligence, has the firm changed? Have they changed glide paths, asset allocation, investment strategies? Has anything really changed? That's step one in the monitoring. Step two is the fund behaving consistent with expectations given the market environment? So again, going back to the due diligence process, if we're in a conservative glide path fund, I wouldn't expect our fund to be a top quartile manager in 2019 when the S&P was up 32%. But in 2020, when the market's down 25% year to date, we would hope that our glide path, our funds would be outperforming on a year to date basis. So understanding glide path and asset classes, what they have, we should then have an expectation of how they're going to behave given the market environment, and are they matching that? And if not, it tells me that we either didn't understand what they had, or they're doing something that they didn't communicate to us, and it's important that we figure that out. If we're using active managers, are the portfolio managers adding value? Are we getting what we pay for in terms of active management? And then lastly, how do these products compare to other alternatives in the market? It's a dynamic market. We see new products coming to market. We see managers making changes. We want to understand the broader context of what we have. And if we follow that process to, evaluate whether anything's changed in our initial selection criteria, confirm that the manager's performing in line with our expectations. If they're actively managed, are they adding value? And we understand where the broader market is. That's a pretty good process for documenting what we have. With that, I guess the last comment I would have before we wrap up today is that I think this is going to become all the more important given the current market environment. We just finished an 11-year bull market where most asset classes did well, stocks did well, bonds did well. Everything performed, as you would expect, and it was hard to be a bad investor in some ways. If you were invested in equities, you saw great performance, and things were all pretty pretty happy. Obviously, given what's happened in the market this past few weeks, this quarter, I think what we're going to see is some stress testing of target date funds. Not necessarily that we're going to have liquidity or other issues, but you're going to put to a test the strategies, the underlying asset allocations that they had. And you may find that what you thought you had isn't what necessarily you ended up having. So it's important, if you haven't done this, to kind of go through this process and understand what you own and see how that will hold up in what's been a pretty difficult market environment. Target date fund selection monitoring is an ongoing process. It's not something that you can set kind of at once and be comfortable that lasts long term. We see changes frequently. There was a target date fund family that we used with our clients in the past year. We've seen changes to the underlying asset allocation, to the investment management team, to the investment strategies that they use. Those are things that you need to stay on top of and know that you're making that ongoing monitoring decision prudently and knowledgeably. With that, I'm going to kind of wrap up here. If anybody has any questions, certainly feel free to use the Q&A in Zoom, or if you want to follow up, feel free to reach out to me. Again, I appreciate everybody taking the time today to join us for the presentation. We are recording it, and we'll send out the recording and the slides in the next few days. Not seeing any questions, so I'm going to go ahead and let everybody go and end the presentation. Thank you.